Two major companies just reported, Nio, Best Buy. We're going to go over their reports. Nio, first off, earnings per share, they lost 45 cents, which was worse than the expected 35-cent loss. And they did $1.21 billion in revenue, which was also a miss of $1.27 billion. But there is some light at the end of the tunnel. Here's the Nio report here. So some bad things right here. Last year, Q2, they delivered 25,000 vehicles. This quarter, Q2, 23,520. Okay, so that is a drop in the vehicles delivered. However, if you look at Q3 last year, they did 31,607. They're expecting for Q3 between 55,000 and 57,000 vehicles delivered. That is a big, big beat. Big increase from last year, I should say. So obviously they see a lot of pent-up demand here of something, because to go from decline in deliveries to a massive increase of 60-70%, that's pretty big numbers, okay? Now, as you know, Nio is a car company that we've talked about a lot. It's the leading electric car vehicle maker in China, with Tesla still going there trying to compete with them, right? So the question is Tesla going to be able to compete there? They're dropping their prices. They're trying to make a cheaper car in India, which I'm sure will lead to more cheap cars overall internationally. But let's look at some other things here. Vehicle sales were 991 million in the second quarter of 2023, which was a decrease of 25% from the second quarter. Even though deliveries were not a drop of 25%, the revenue was a drop of 25% and a decrease of 22.1% from the first quarter of 2023. Okay, that's pretty big, pretty disturbing. Vehicle margin was 6.2% compared to 16.7% last year's same quarter. Guys, that's a gross margin difference that's huge. As you know, we did a video on Ferrari just to show how different Ferrari is and these other manufacturers. Their margin is 49.8%. Tesla's is around 18 or 19%. So this is a big drop overall. All right, so total revenues were $1.2 billion in the second quarter, representing a decrease of 15% from last year's second quarter. Gross margin was 1% in the second quarter compared to 13% in the second quarter. Oh, interesting. Oh, okay, got it. So vehicle margin versus gross margin. Gross margin is probably going to have some advertising costs in there and other costs that are attributed exactly to the car versus the exact vehicle margin. That's pretty bad. 1% for gross margin versus 13% for versus last year. And again, the margin I was telling you about before, the gross margin for Ferrari and Tesla, was this number, not this one. Loss from operations was $837 million in the second quarter, which was an increase of 113.5%. So guys, it's tough. Let's see what Nio's doing right now. Nio's down 8.5%. They're at 91 cents. Their all-time high was $67 on January 11th, 2021, in the height of the EV hype train. At the peak of that. I remember January and February, Kathy Wood could do no wrong. ARK Investments is at 160. All these YouTube hypesters were out there plugging all these stupid stocks like Tattooed Chef and Nio and Nikola and Workhorse and all these dumb companies that had zero revenue but were selling for tens of billions of dollars. And go back and look at our videos. We said, be cautious. It was good timing. Usually what happens is when we say be cautious, the stock goes up for a while, people tell us we're dumb, and all of a sudden there's a fall, and then people forget about that. And then they say, you lost 4% on this company. So guys, with Nio, it's still hard for us because this is what I look at with car companies that don't make money. I'm gonna look at their price to sales ratio, okay? The reason being, in the US, even foreign car companies, they average between 0.5 and 0.8 times sales. So if the company generates 10 billion in sales, the market cap will be between 5 and 8 billion. But for Nio, they're at 2.4 times sales at the current stock price. So that's 4 to 6 times greater than what the average car company is right now. Now, Nio has a lot more growth potential. So should you pay a premium for that? Sure, as long as all the numbers are the same. But you have to support losses along the way. And guys, there's only two ways to support losses. Either take on debt to pay those losses or issue more shares, which is bring on more investors to pay for those losses. In the first one, when you take on debt, it makes the company more risky. In the second one, when you take on investors and more shares, it dilutes you as an owner. So instead of splitting the company up amongst a billion shares, they're splitting the company up against 1.2 billion shares. And over time, you get less and less ownership of the company. And we always are apprehensive about that. So again, do your analysis on Nio. Until it can generate some cash flow and profit, you have to focus on this price to sales number. Because look, their free cash flow last year was a loss of $5 billion. That's insane. In the last 5-year average was about $900 million per year. So you got to focus on this price to sales ratio in terms of comparing this company to other auto industry companies. Now remember, the auto industry is a very, very, very tough industry. Very tough. In fact, for me, the only one that I even been interested in looking at is Ferrari because of their high gross margins and high bottom line profit, because they're a luxury brand and they can price dictate things, and they keep, Ferrari sold 13,000 cars last year. These guys are selling, and they're growing, and they're selling 13,000 cars a month. It's a lot different brand, but again, different market. And that's why I get worried about the average car company. It's a very saturated market. It's hard to compete in there. It's a very capital intensive business. Okay, next company, Best Buy. Let's pull up Best Buy and see how it's doing before I give you the results there. So I'm going to pull up our software, BBY. Best Buy is up 6% right now. Now, they reported $1.22 in profit versus expectations of $1.07. So they beat very well, 14% on earnings, and they did $9.58 billion in revenue versus $9.53 billion. You sit there and say, that's awesome. But here's the report from Best Buy, and the first line I don't like. Comparable sales declined 6.2%. That means looking at stores that have been around for 12 or 18 months or more, the sales are down 6.2%. That's concerning for me. That's very, very concerning for me. Now, look at these projections for Q2 fiscal year 2023 versus 2024. There's a lot of declines here. I don't like that. I do not like that. Oh, actually, I'm sorry. This is the Q2 2024 right here. Wow, big drops here. 6.2. Oh, boy. Now, the income was up. EPS was down 1.35 to 1.25, and non-GAAP of 154 down to 122, which is they reported. Oh, I just don't like that. So the guidance for next year, the revenue of 43.8 billion to 44.5, which compares to guidance. So they decreased the high end of their guidance from 45.2 billion down to 44.5 billion. Comparable sales decline of 4.5% to 6%. Oh, which is higher than their low side of 3 to. So guys, comparable store sales are still declining. Now, if they're making it up for that in online sales, awesome. But I don't know if we're seeing that here. I don't know if we're seeing that. Oh, and that's with the 53rd week here. So a lot of times, guys, these companies will have an extra week in the year based on how that's assuming a 53rd week, which is expected to bring in $700 million of extra revenue. And that's still missing. Oh boy. Oh, here's some good news. Domestic gross profit was 23.1% versus 22% last year. Now, guys, even though this is not the best, you can still make money in a company like Best Buy, even with declining sales. Just because something is declining doesn't mean it's worth nothing. The question is, if the stock is cheap, can they buy back shares? So let's see what the stock is right now. The stock's current PE is 12.7, and the 5-year PE is 9.6. They have a very healthy dividend yield of 4.7%, which eats up about $800 million of their cash flow. And in the last year, they had $2 billion in cash flow. In the last 5 years, 2.1. Okay? And a very high return on invested capital. So there's a lot of positives here for Best Buy. Let's go look at their 8 pillars. Oh, wow. The only X is their net income of a decline of $200 million since 5 years ago. All right, so let's go look at their income statement. Remember, guys, if you have our software, you can customize your 8 pillars. So I want to make sure you do that. So, guys, this is their revenue over the last. Okay, now remember, we're coming off of some COVID times, so they're still higher than pre-COVID. That's a positive here. I think that's a very important positive that everybody needs to focus on. They still have higher revenue than pre-COVID. Okay, and during COVID times, a lot of people were spending a lot of money on devices, and so this is why we look at the numbers. Net income. I mean, for a company that's pretty impressed with this, guys. Taking out these 2 years of major COVID spend, I mean, it's pretty consistently over $1 billion. I'm feeling a lot better about Best Buy here. All right. Now, here's what I love about Best Buy. 10 years ago, they had 347 million shares outstanding. Today, 219 million. They are buying back shares like crazy. And this is what I guess is going to be how Best Buy makes the investors more money. They're going to continue taking their cash flow and buying back shares. In fact, I would encourage them to stop paying that dividend. The market cap of the company is $16 billion. They're paying $800 million a year in dividends. If they just stop that, they can buy back 5% of their shares every year. And if the market cap stays the same, they could buy back over 50% of the company in the next 10 years and increase your ownership by double. It would increase the earnings per share by double. That's going to be much better for you as an investor than paying out that dividend, which you have to pay taxes on. That's incredible. Man. All right. So let's see what analyst estimates are saying for Best Buy. Okay, look at this. Increasing their earnings per share. Why? Probably buying back a lot of shares. Their earnings per share are going from $6.67 estimated last year to $10.18 in 4 or 5 years. Revenue? Some minor growth in revenue, nothing major. $47 billion to $49 billion. Not major growth. So I guess it leads us to the stock analyzer tool. What price do we want to pay for Best Buy? And this is why we use a stock analyzer tool. So if you like this, guys, and you like all of our other tools, you've watched our videos, there's so many other tools in the software. We're making it better and better every single month. But more importantly, the community chat, thousands of investors. Because guys, investing is a lonely journey at times. And it's nice to be around people who are like-minded. Like-minded doesn't mean everybody agrees. I just saw somebody today, they tagged me and said, Paul, look at my analysis of this company. What do you think? I tagged everybody else and immediately 5 or 6 comments came in saying, hey, I think your assumption here is a little off, but I like this, blah, 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 blah. That's the point of the engagement community. So if you like that idea, if you like 10,000 companies on your phone, this entire software on your phone, on your desktop, subscribe to the software, everythingmoney.com. Go check it out. It's about $1 per day, everythingmoney.com. So let's go back and look at what was the last time I did Best Buy. So I'm going to pull up in our history. I did it just last week, a week ago today. Okay, I like these assumptions. So I did, for revenue growth, our first line here, I did -2%, 0%, and 2%. For profit margin, historical was about 3 to 4%. I did 2.5%, 3%, and 3.5%. So I factored in lower profit margin here. Now, this is what I love about this company. The free cash flow is better than the net income over the last 10 years. That's huge. That is awesome. Big benefit. And now for ending PE, it's a declining business. I put 8, 11, and 14. Trying to be conservative. Same with free cash flow. And because it's retail and there's a lot of risks involved and there's a lot of problems in retail, I did 12, 14, and 16% return that I wanted because I need that margin of safety. And the higher my desired return, the more margin of safety I get. Okay? I hit the analyze button. And guys, look, I did 35 to 50 here. High side 64 to 81, middle side 50 to 65. So I'm willing to be patient. I have it on my watch list at $60. And if I pay today's price and the low assumptions occur, I'm gonna make 4.5%, including my dividends. Middle assumptions occur, 11%. High assumptions occur, 17%. So guys, check it out. Don't buy a company just because it's all green or don't ignore it just because it's all red. Go to everythingmoney.com, sign up for the software, $1 a day. It makes perfect sense. Thank you for your time.